Hi, it's Joni Michaels, and it's my pleasure to introduce you to Joe Clark, host of Consider This Program. Joe's a certified financial planner and former professor at Purdue University. He's the managing partner for the Financial Enhancement Group. Joe's passion is teaching people about their money so they don't make inefficient financial decisions that lead to frustration and devastation. The Financial Enhancement Group serves more than 900 families in 31 states and manages more than $400 million. The Financial Enhancement Group takes care of people who don't want to worry about their money so they don't make inefficient financial decisions. Joe addresses your questions about money in 5 critical elements of finance: retirement planning, or what we like to call your life after work, tax planning, investment planning, life happens, the good, the bad, and the ugly of life, and legacy planning. The Financial Enhancement Group can be reached at 800-928-4001 or visit yourlifeafterwork.com. The Financial Enhancement Group is an SEC-registered investment advisor. Securities offered through World Equity Group, Inc., member FINRA, SIPC.
Well, good morning and welcome to Consider This. I'm your host, Joe Clark.
I'm Ken Dilger.
And I'm Angie Kinzer.
Happy to have you along as we float through the month of January. You know what that means. We are approaching tax time. And I promise to be bringing you plenty of information and insight into things that you need to consider as you prepare for taxes. There is no time like the present to sit down and to deal with it. But Ken, there were major changes last December. And in full IRS way, things change. And we all know there's 2 tax codes in the United States, Angie. What are they?
One for the informed and one for the uninformed.
And which are we?
Informed.
We are informed. And hopefully, if you're listening to the show and you've been around long enough, you too fall into that. You are informed. Well, we passed this cute little thing called the Secure Act. And the Secure Act stands, let's see if I can find this, because it is not something that I would normally have thought about. And this is marketing people coming up with a name. It's setting every community up for retirement. And I will tell you that there are some really extraordinary things that are in the Secure Act, Ken, that I really give Congress kudos on getting passed.
Really? That's a first?
Right. I wouldn't say it's a first, but it was nobody really wants to know how the sausage is made. And in case you didn't know it, Congress had actually passed what was the Secure Act earlier this year, probably back in the middle of the summer. So we knew some ideas about this. And then all of a sudden we had to get a bill through that the Senate had to pass, the president had to sign, and he had to get it essentially done at the last minute in order to have the funding for the budget. And in typical Washington manners, if y'all add this, we'll sign that, right? Yep. It's a tit-for-tat kind of deal, and away we go. And the bill's signed, and now we get to deal with it. And so I believe it was I apologize for not knowing basketball. David Stern, was that his name?
Mm-hmm, the commissioner.
And he died January 1st of this year.
Correct.
And it cost his family probably at least 6 figures in taxes, because if you died before December 31st, what happened to your IRA and your tax-deferred accounts is dramatically different than what happened if you died on January 1st. So a few hours became quite costly. I hope it was worth it for the family. Anyhow, we're going to break that down today in the Secure Act, what it means for you, what it means for your family, things that you need to consider. You will hear a lot of these things talked about. We're going to try to break it down and give you the things that matter most to you and your family. You got a question or comment, give Angie a call, 800-928-4001. We are more than happy to talk to you and to help in any way we can. Again, it's 800-928-4001. If you want to do this on your own, that's your business. If you're looking for a fiduciary, that's our business. More than happy to sit down and have a cup of coffee with you, talk about the Secure Act and other things financial that you need to know. We'll take a break and be right back.
Hi, Joni Michaels here. We know you care about your money, but are you tired of worrying about it? The Financial Enhancement Group takes care of people just like you who don't want to worry about their money. As fiduciaries, the team at the Financial Enhancement Group will care for your nest egg just like they would care for their own if they were in your situation. There are many decisions you'll need to make as you face retirement, and the team at the Financial Enhancement Group is here to help you. Call 800-928-4001 or go to yourlifeafterwork.com to set up a time to meet. The confusion and complexity of retirement is almost as daunting as is the excitement of retirement. Don't let your fear and frustration of taxes and investing derail your retirement. Call the Financial Enhancement Group at 800-928-4001. They'll give you a complimentary second opinion on your strategy for retirement. Begin your adventure in your life after work. Call 800-928-4001 or yourlifeafterwork.com. Now back to Consider This program with Joe Clark.
You know, there's an old saying that there are two things that are certain in life. One, that you will die. Two, that you will pay taxes. The third one that I would add is that the IRS will change their mind. Yes?
Yes.
I'm Joe Clark, host of Consider This, along with my friends.
I'm Ken Dilger.
And I'm Angie Kinzer.
Happy to have you along as well. At the end of the year last year, Congress, the end of 2019, Congress passed an act called the Secure Act. And we're going to break that down for you on this show today, just so you understand what's coming. Angie.
Yes.
Literally, everybody was impacted by the Secure Act. Unless you have no parents, you have no IRA, and you have no beneficiaries, then you don't have to listen to the rest of the show.
Okay.
But rarely does something come up that that will touch every generation. It will touch your kids, your beneficiaries. It will touch your parents if they're still around. So if you're a normal family that's walking around and you've got access to say, hi, Mom, hi, Dad, how's life? And you and your spouse are married, or even if you're a professional on your own, and if you've got people that you intend to leave behind to your IRA, this thing matters. We are more than happy to have a conversation. If you want to give us a call at 800-928-4001, Angie would be more than happy to answer your questions and get you set up to come in and talk to somebody on our advisory team. So let's start with the basics. The Secure Act, setting every community up for retirement, is what they dubbed the act. You're going to hear it called the Security Act. It is designed to raise $16.4 billion. That's the big B word, billion.
Where's that coming from?
Tax revenue, because they've eliminated a thing called the stretch IRA. Before I can get there, and of the $16.4 billion they think they're going to save, Congress says $15.7 will come directly from the loss of the stretch. We'll get to that in a conversation on down the road, but I want to give people the basics here of what's going on. So over a 10-year period of time, 2019 to 29, they expect $16.4 billion to hit the coffers. Congress rarely passes a bill where they don't believe that will add money to the till. I think they have actually missed a major point. And I will tell you, if you're listening to this show, the odds are you are more like me than not. If you're taking your time to pay attention to the financial world that's out there. Most of us, when we were younger, Angie, started saving for retirement, right? So we would have a better retirement.
Yes.
Right? And then eventually, Ken, you know, the kids, and I know you're not there yet, but the kids will leave home, Ken.
I hope so.
They will leave home, right?
I tell my son, Zach, all the time.
Yeah.
Like, turn on 18, get the hell out of the house.
It is
Take a
time,
hike,
right? It is time. So the statements come, and you know, the kids are still there, and we don't really pay attention to the investment statements. We're just kind of saving for retirement. You're putting money in your 401k, you know, but eventually the kids leave, and the statement reaches a certain amount of money. And you see that dollar figure, and it takes on a part of our identity. I mean, we've worked hard to build that, and that statement comes, and you see that dollar figure, and it is hard to imagine ever spending that money, right? Now, Congress knows this. If they looked at the reports, I think the last data we had in 2016, 68% in that year of IRAs and 401ks were not accessed for the first time until people had turned 70 and a half. That was the year they were forced to pull the money out, right? So I know you're putting money in, Ken, because you're saving for a better retirement.
Mm-hmm.
I'm just telling you that you're going to get to a period of time when you can take money out, and you're going to go, no, I don't want to do it, right? Now, we hear things all of the time. You've heard probably, if you've listened to this show, that according to the research, 76% of people are not prepared for retirement. I'll buy that. It's just not the 26% of the people, or the 76% of the people that we talk to here at the Financial Enhancement Group. right? That I take care of people who did pay attention to what was going on, who have saved and accumulated money. That's who we help. Take care of people who don't want to worry about their money. It didn't mean they didn't save, right? It just means they don't want to spend their retirement years, probably just like you, don't want to spend their retirement years sitting down and studying what a market's doing, the changes in the tax code. They want to really know what's going on and enjoy life. Let somebody who is professionally trained to be able to do this. So one of the things that happened in the old days, last year, right? So what, 20 days ago or less, or something like that.
Way
right?
back then.
Way back 20 days ago. That's how quickly this stuff can change. If you were over 70 and a half, you could not contribute to an IRA. Now, you can contribute to a Roth IRA, but if your income was too high, you couldn't do that. Now, Ken, you're probably going, Joe, what kind of person over 70 and a half years old, because you do still have to have earned income, what kind of person over 70 and a half years old is actually working, right? You would be amazed the number of people that we have
I'm sure.
that are over 70 and a half that are they've got a part-time job at Lowe's, not because they need the money, right? Because they want to do something, right? I mean, they whether it's a consulting company, whether they're helping a kid's business out, they've got a little bit of income. Now you have the ability, if you want to be able to put that into an IRA. I think that is a beautiful, beautiful
So let me
thing.
ask you this: is earned income only have to be a W-2 or 1099, or can it be a pension, SSA?
The best way to think about it from my poor little brain is it's money that you have to pay Social Security taxes on.
Gotcha.
So the example that you gave is no. You don't pay Social Security tax on pension money. You don't pay taxes on
Social
pension
Security?
money, on Social Security. You don't pay Social Security tax on Social Security as of right now, right? But stick around, stay tuned, baby, because this can change quickly. And that's, as I like to say, there are two tax codes in the United States, one for the informed and one for the uninformed. And when things change, believe me, there's a lot of people out there that are uninformed. This change was not as significant as what happened December 22nd of 2017. That was the largest overhaul in the tax code in my 32-year career. But this one is a big one, and it will impact even the young Ken Dilger. And Angie and I are allowed to say that, so we're able to pick on him. So what does this mean if you can contribute to an IRA if you're over 70 and a half? It means if you have earned income, suddenly the backdoor Roth IRA option is available. So if your adjusted gross income is low enough, you've got earned income, you're over 70 and a half, we would have had you contribute to a Roth IRA. But a lot of people can, because of Social Security, because of pensions, because of other investments, don't qualify to contribute to a Roth because their income's too high. Suddenly the backdoor Roth becomes an option. So that is one big thing to be able to be aware of, and it's very, very important that we're able to sit down and to have these conversations. I'm going to hit one last thing in this segment, just so you know, the medical expense world also got a change. One of the changes that happened in the 2017 code is that the itemized deduction for medical expenses went from 7.5% of your AGI up to 10%. Well, suddenly that's back. It's 7.5% now, and that includes 2019. That is a beautiful thing. So the higher your adjusted gross income, the less you're able to deduct. But at the same time, if you had a bunch of bills, it's a beautiful thing. Also, there's a 10% penalty exception, and Angie, this is out of both IRAs and 401k plans, tax-deferred plans of any kind. If you have a baby or adopt a kid, you can take out $5,000. So if Barb and I adopted somebody and she had IRA money and I had IRA money, we could both take out $5,000 per child to help offset those expenses. You still pay the taxes, but you don't pay the penalty. Hey, you're listening to Consider This Program. I am your host, Joe Clark, along with Ken Dilger, Angie Kinzer. Happy to have you along. You got a question or comment, give us a buzz, 800-928-4001.
Hi, Joni Michaels here. Joe's been hosting financial radio programs for over 20 years, and during his 7 years at Purdue, Joe developed the 5 critical elements. You see, there are 5 areas we all go through that can impact and even derail our retirement plans. YourLifeAfterWork.com has been focused on you on your retirement for over 20 years. You may have had a 401k as well as IRAs. Those are all defined contribution plans. Consider this program is about your defined contribution plans becoming defined distributions. You see, we all exit. You'll either take money out of those retirement plans when you decide or when the IRS decides, or your heirs will have to deal with the situation, but we all exit. I encourage you to call 800-928-4001 to meet with one of the talented financial advisors at the Financial Enhancement Group. I've listened to this show for years, and what Joe says just makes sense. Don't you think it's time for you to call 800-928-4001, YourLifeAfterWork.com. Now let's get back to the show.
Have you ever wondered what a stretch IRA really is? No, it's not yoga. It's not preparing for an athletic event. It's how most people wanted and intended their IRA assets to work. Welcome to Consider This Program. I'm your host, Joe Clark.
I'm Ken Dilger.
And I'm Angie Kinzer.
And we're happy to have you both along. We are dealing with the Secure Act, a change that just occurred in very, very late final hours of December of 2019 and became effective January 1 of 2020 for most people in the world. So we're going to talk about a stretch IRA. So Ken, now you're not expected to know the answer, but I'm going to give you a shot. What do you suppose a stretch IRA, what does that mean?
I have no idea. Stretch it past 70 and a half.
Well, okay, sort of. I'll give you that one. Angie, what's a stretch IRA?
I believe it is an exercise.
It is an exercise. It's I'm trying to think about my yoga exercise, the reverse pigeon. I think that's the one that I learned this week. Yes, I have to learn them one at a time because I'm slow and trying to figure out those moves. I love yoga, though. This is a great thing. In the Secure Act, we will figure out, but it's not something that I can necessarily say that I love right now. Eliminating the stretch IRA is a challenge for many, many people. So what is the stretch? First of all, it was nothing that you would ever find in the tax code. It does not exist in the tax code. It's something that we named in the tax code to help you understand what your options were. So Ken has a beautiful bride and 2 children. And so if you looked at his 401k plan or you looked at his IRAs, his beneficiary is his bride. In his 401k, it has to be. In his IRA, it's that way because he chose it that way. And Ken, if something happened to you and your wife, now I know that your kids aren't always on the top of your list, but they probably are still the contingent beneficiaries. Is that fair?
Yes, they are.
So if something happened to you and Heidi on the way up to Chicago or wherever else in a car wreck, God forbid, those kids are going to inherit money. Now, what happens in the past, so pre-2019, 2019 and before, what happened is they were eligible for a concept that we call the stretch IRA. They had the ability to take money out of your pension plan, your IRA, your 401ks, over their life expectancy. Right? So it's a key thing. They're younger, they could take minimal amounts of money out. Or they could take it all out if they wanted to in 1 year. We don't see that happen a lot in our office, but believe me, it happens a lot across the country. Right? So people have access to the money and suddenly houses get paid off, cars get bought, vacations are taken. That's why I always tell people you might as well go first class because your kids will. Enjoy life that you worked so hard to save if you can get yourself to do it. But the concept of the stretch was delaying the inevitable, which means the IRS being able to tax your dollars. They don't, even though they're not 59.5, they didn't have to pay the 10% federal penalty, but they did have to pay taxation on the money that you pulled out of the account. Make sense? Okay. So all of a sudden, the stretch IRA is now gone. Right? Now, Angie, the deal is Ava would have to take the money out after or at the end of a 10-year period of time. It no longer matters how old you are when you die, right? Doesn't matter if you had before the retired beginning date. Didn't matter if it was after the retired beginning date. All those complicated dates that were there. The old rule was you had to take a required minimum distribution technically the year after the year you turned 70 and a half. But if you did that, you had to take 2 distributions in the following year, the first one being before April 1st. See all these things I memorized, Ken, that are now worthless? Absolutely pointless.
True.
So one thing I will tell you is if you had already inherited an IRA, if you've already died prior to December 31st of 2019, I'd like to know how you're listening to the show. I can't imagine that God would be playing this in heaven. But if somebody in your family passed away prior to December 31st of 2019 and was taking required minimum distributions, the old rules apply. If you were already taking RMDs yourself, if you are alive and over 70 and a half, the old rules apply. That means you're still taking an RMD in 2020 and 2021. And then in 2022, you get to do it again. Now, a lot of people are going to start to call to ask the question, what does that mean for the qualified charitable distribution? Because that was at 70 and a half. And I'm a big fan. I will tell you here and now, especially if you take the standard deduction, right? Especially if you take the standard deduction. If you're over 70 and a half, if you have IRA money, notice I didn't say 401k, this just has to be IRA. So let me start over. If you're over 70 and a half, and if you are charitably inclined, and if you take the standard deduction, the QCD or qualified charitable distribution is the biggest no-brainer I have ever seen in the tax code. This one is not tough. Do you want to pay more taxes or less taxes, Angie?
Let's see. How about less?
We did have a person last year. I mean,
Yes.
I am not designed for everybody, evidently. We did have a lady get mad at me and said she thought it was her responsibility to pay all the taxes that she could pay, and that I was essentially
That's a first.
Essentially,
She
I
did.
was evil for teaching people how to pay less taxes. Thought it was very, very interesting. But hey, we take care of people who don't want to worry about their money. My job is to help you reduce financial regrets. That's what we do. And if she would regret paying less in tax, I was clearly not for her, right? So the QCD is a big thing. It is still open at 70 and a half. It hasn't changed. Now, there are exceptions into the stretch IRA being gone, right? The first one is that if it's your spouse, so if Heidi inherits the money because you kicked the bucket, Ken, she's still good to go. A spouse can still do what a spouse was going to do with the money. If they're minor children, they're still good to go until they reach that age of majority, and then suddenly their clock is now ticking, and they'll have to take the money out. So you've got spouses, minor children. If you're disabled, you've got an exception. If you're chronically ill as defined by the tax code, right, then you're exempt from the new rules that apply with inherited IRAs. And if your beneficiary is not more than 10 years younger than the deceased. So let's say something happens to me and my wife decides to marry a 40-year-old or 30-year-old, right? Barb, that'd be a really bad plan, I'm just saying. But if she did, right, and then my daughters were the contingent beneficiaries, they would be within 10 years of the 30-year-old. And so in theory, the rules wouldn't apply. Now, let's not be thinking like that or doing anything like that, but there are some exceptions to this rule. So you're just going to have to get used to them to understand what's going on. What I will tell you is if you have a beneficiary that is a trust, whether it be what we would know as a conduit trust, a beneficiary that is a discretionary trust, any of those things, many of the things that we've helped people with for the last 10 years here at the Financial Enhancement Group, I've really been paying a lot of attention to those. A lot of that stuff has to change. And we've got letters that we're getting ready to send out to the families that we take care of to say, hey, it's time to come in and have a conversation so you understand what it is we're dealing with. Hey, you're listening to Consider This Program. I'm your host, Joe Clark. Remember, if you want to do this on your own, that's your business, and I hope this show is helping you reduce financial regrets. If you're looking for a fiduciary, that's our business. Give Angie a call at 800-928-4001. Set up a time to come in, have a cup of coffee. Let's see if we can be of service.
Hi, Joni Michaels here. We know you care about your money, but are you tired of worrying about it? The Financial Enhancement Group takes care of people just like you who don't want to worry about their money. As fiduciaries, the team at the Financial Enhancement Group will care for your nest egg just like they would care for their own if they were in your situation. There are many decisions you'll need to make as you face retirement, and the team at the Financial Enhancement Group is here to help you. Call 800-928-4001 or go to yourlifeafterwork.com to set up a time to meet. The confusion and complexity of retirement is almost as daunting as is the excitement of retirement. Don't let your fear and frustration of taxes and investing derail your retirement. Call the Financial Enhancement Group at 800-928-4001. They'll give you a complimentary second opinion on your strategy for retirement. Begin your adventure in your life after work. Call 800-928-4001 or yourlifeafterwork.com. Now back to Consider This program with Joe Clark.
Have you been dreading and waiting for that required minimum distribution? Kind of waiting for Halloween for a lot of people, because it's certainly not Christmas. It's not a happy day for most people. But if you've been waiting, well, you get to wait a little bit longer. That could be good news or bad news. I'm the host of Consider This, Joe Clark.
I'm Ken Dilger.
And I'm Angie Kinzer.
The Secure Act has passed. It is real. It became effective January 1 of 2020. The question is, what does this mean for you, your IRA, and your 401k or 403b? Well, first of all, what is a required minimum distribution? Angie, you want to take that one on?
Sure. That's when you reach a certain age, finally, the IRS is going to say, where's our money? Because you've deferred your taxes up until that point. So your required minimum distributions are the amount that you're forced to withdraw and pay taxes on.
Well, that's pretty good. We'll just call this the Angie Show going forward.
Okay.
We'll let you do that. So it's Ken, it's as simple as you break down the words required.
Right.
All right, this is not an option. This is
Forced.
this
Mandatory.
this is forced. In 1980, we essentially created defined contribution plans. That's our 401ks, our 403bs. Nobody had any idea that people would be walking around with $1 million, $2 million 401ks, and we probably have 30 or 40 plans that are way over $1 million. I don't mean company plans. I mean individuals that are over there. It's very, very, very surprising to a lot of people to know that happened. Many people, most people in my opinion, don't want to touch that money until they have to. And that rule had always been the year you turn 70 and a half. Technically, it was the year after the year you turned 70 and a half, which made it even more confusing because in that next year, Angie, you had to take 2 distributions, right? So when things confuse your CPA, you shouldn't have to deal with them from a tax standpoint.
I always wondered why they said and a half. That didn't make any sense.
I'm sure it had to do with an original life expectancy table would be my guess, but I can't tell you that for sure. That or a senator was already at that age and was trying to delay. Some of the stuff that happens in Congress you really don't want to know about. Anyhow, the required minimum distribution has been changed. It's been delayed. It's no longer 70 and a half. Now, if you were already taking them, you have to continue, Ken, right? So if you were already on this prescription, even though the Congress says you've got a better prescription, you still have to take the old one, right?
Gotcha.
That's the only way that I know how to really kind of explain that crazy rule. It said no delay. If you're already paying, you're still going to pay. Congress believes that this is going to add about $16 billion in revenue to the tax coffers over the next decade. So it is a big deal. Most of that came from what we already talked about, Angie, which was the stretch IRA. If you missed that, don't forget you can always go back and listen to the show. Just go to our podcast, Consider This Program. You do have to type in the word program, and you can listen to the segments when you would like. If you have a problem figuring out how to get to a podcast or you're not used to listening to them, if you give us a call at 800-928-4001, we can walk you through how to put that on your phone so that you're always welcome to listen to it on the radio, but you can go back and listen to the conversations that you really want to get into. So when I said earlier in the introduction, Ken, that some of the things in here were nice, right? So delaying your required minimum distribution till 72, I'm not going to put under nice. But that is, for people who now have 2 more years of planning, or at least 18 months more of planning than what they would have had before, I guess you can call that an option. One of the things that got updated though is the life expectancy tables that are in there. So they don't change technically until 2021, but what that essentially means is you have the capacity or the ability to take out less money as a required minimum distribution while you were alive. Now, on the stretch in the last segment, we talked about if something happened to you, your kids have to take out required minimum distributions under the old rule. They have to take out income based on their life expectancy because Ken, you were not at 70 and a half when you died last year. Now, just for the record, as Mark Twain would say, the stories of my demise have been greatly exaggerated. Ken is still here with us today. So he's still here and going at it. So now it's 2020. So if something happened to you today and your kids were the beneficiary, they don't have to take out required minimum distributions at all. At all. Those are gone. We don't have to calculate them for kids. So a lot of the issues with inherited IRAs that were out there that confuse people, those are gone. However, at the end of 10 years, the accounts have to be emptied. So if you've got a $500,000 IRA that they don't touch and they take money out over a 10-year period of time, that money is going to continue to compound. It's going to continue to grow. And at the end of the 10th year, they're going to have to take it all out at one time, right? So if you're going to do good tax planning, ideally, you're going to take some of that money out over the 10-year period of time to try to make your situation a little more spread out. Typically, people leave money directly to their spouses. So I always try to give you guys next steps on this. People ask, Joe, if we come into the office, what are we going to get? We have what we call the next steps meeting that Angie can set you up to come in and have. And if you sit down, we're going to give you things that you need to consider today, things you're going to need to consider tomorrow. And if we partner together, we'll give you in writing exactly what it is that we're going to do for you. Well, one of those things that you may want to consider tomorrow, it's not a quick decision, but because this rule has changed with required minimum distributions and the rule with the stretch, so you got two things working together, we're going to see some people who make their kids, instead of their spouse, part of the beneficiary on their IRAs. That will allow them to have money come out over 10 years in a smaller amount, right? And then turn around and presumably the mom, because 70% of the time the female is the surviving spouse, then mom passes away and then you get another chunk and you've got another 10-year window. So it would force you to put less money, force you to pay less money to the IRS. This 10-year deal is really, really a big deal. We don't have anybody in our firm because I am so, I do my best to try to keep people from doing them. But remember, there are people who take money out of IRAs early through a process called a 72T. If you're taking substantially periodic payments, substantially equal periodic payments, sometimes you'll see it abbreviated as SEP, S-E-P-P, substantially equal periodic payments. If you're taking those out of your IRA already, and you're not 59 and a half, or if you've not been doing that for 5 years, you have to update those life expectancy tables in 2021, or you will subject yourself to great deals of pain inside of the tax code. These are not things to mess around with. I would strongly encourage you to get with somebody who understands what's going on. I spend 3 days twice a year in a room with 350 CPAs, tax attorneys, and other geeks like me. I know Ken wants to go he says, Joe, is this the week we get to go? Right? And
I know you're golfing in there somewhere.
Yeah. Yeah. Barb went to the last one with me, and she goes, we were in San Diego, and I never saw the sun. My first meeting usually starts at 6, and I get done with my after meeting somewhere around 8:30 or 9, and you walk to a place, you eat, you go pass out in bed, and you get up and do it again. And why do we even bother to go to San Diego? I mean, it's
Right.
kind of, why do you spend the money? So I think this year it's in Vegas. That ought to be really helpful. But the hotels are cheaper, and so there you go. So, but we're going to break this down and continue to break it down. You'll hear me talk about it all year long. But it is nice to be able to pick up a phone and call 350 other people who are as committed to getting your IRAs right as we are. We reduce financial regrets. Please do not get trapped by this confusing tax code, because there really are two, one for the informed, one for the uninformed. 800-928-4001 We'll take a break and be right back.
Hi, Joni Michaels here. Joe's been hosting financial radio programs for over 20 years, and during his 7 years at Purdue, Joe developed the 5 critical elements. You see, there are 5 areas we all go through that can impact and even derail our retirement plans. YourLifeAfterWork.com has been focused on you on your retirement for over 20 years. You may have had a 401k as well as IRAs. Those are all defined contribution plans. Consider this program is about your defined contribution plans becoming defined distributions. You see, we all exit. You'll either take money out of those retirement plans when you decide or when the IRS decides, or your heirs will have to deal with the situation, but we all exit. I encourage you to call 800-928-4001 to meet with one of the talented financial advisors at the Financial Enhancement Group. I've listened to this show for years, and what Joe says just makes sense. Don't you think it's time for you to call 800-928-4001, YourLifeAfterWork.com. Now let's get back to the show.
Do you have parents with IRAs or 401ks, money that they're not intending on using? Join us on Consider This program this week as we talk about what that really means for you in your future. I'm Joe Clark, the host of Consider This program.
I'm Ken Dilger.
I'm Angie Kinzer.
So here's the deal, Ken. Your parents are still with it.
Yep.
Mom and dad have saved a little bit of money, probably have a defined contribution plan. I didn't always get to say that. You're one of the few people in your family at your young age that probably actually has a pension,
Right.
a defined distribution plan. Most of us have a defined contribution plan that suddenly one day becomes a defined distribution. That means the IRS determines that you will take money out in the form of required minimum distributions. Congratulations, the C becomes a D. Right? So one of the things that I've encouraged families to do over the years is if you are doing okay, you're a professional and life is going well, and mom and dad are still alive, and mom and dad have IRA or 401k assets, so any tax-deferred assets. And I would even include this inside of annuities that they've bought so that they didn't recognize taxation. Because if you inherit an annuity, Ken, it's going to be taxed, the growth on that annuity. We're not talking about an IRA now, just a regular annuity. That annuity, the growth will be taxed at ordinary income rates at the beneficiary's rate. That means that's money that's all thrown on your tax return as the beneficiary upon your parents' demise. So if you're already making $100,000 a year and you're in the 22% bracket, and all of a sudden you inherit something that's got $200,000 worth of taxable income, you just threw yourself into the 28 to 32% tax bracket. Congratulations. The IRS got paid more. And so I've advocated for a long time that you need to pay attention to 3 generations of tax returns. I pay attention to my mom's. She's still with us. My dad is not. She's retired in Sarasota, Florida, so it doesn't matter that she's in a different state. I pay attention to my mom's tax code. I pay attention to my daughters, who both happen to be in Indiana, right? Both working. One's in college and working, but they're both working. So I pay attention to what's going on all sides of those. There is going to be money at some point in time that I will probably inherit, or Barb will inherit from her parents at some point in time, that will come to us. So not pay attention to their tax returns makes no sense, right? The Secure Act being passed just made this more important than ever, right? So both of my in-laws and my mom are both over 70 and a half right now. So under the old rules, if something happened to mom and dad, if something happened to any of the 3, we would have to take money out of their tax-deferred accounts over their life expectancy. Now, that may sound hilarious. How does somebody who's dead have a life expectancy? Well, that's the way it works, Ken. Life expectancies are averages, right? That's all they are. And we would have to take the money out over their life expectancy. Today, that rule is gone. Now we're forced to take all of that money out over a 10-year period of time. Now, if your mom and dad have got, $50,000 or $100,000 and you've got 2 or 3 siblings, this isn't that big of a deal. But if there's $1 million IRA that's sitting out there and you're going to inherit it, and mom and dad aren't spending the money, they're They're taking out the required minimum distribution, maybe doing the qualified charitable distribution, the QCD, the biggest no-brainer in the tax code, in my opinion, if you're charitably inclined. And they're not using the money, and you're going to inherit the $1 million. Now you know you're going to have to pay taxes on that entire $1 million over a 10-year period of time. Now just think about how much of that the IRS gets. Now go look at your mom and dad and say, okay, mom and dad, if you were to get the $1 million over 10 years, how much would you pay in tax? And if I was to get the $1 million over 10 years, how much would I pay in tax? Now, mom and dad may look at this and go, well, it's none of your business, right? And that happens. There's some
Right.
people who don't want to talk about money. I want to talk about money all the time. That's my job. So assuming you come from that scenario or that situation where you can sit down and talk, and we just had 2 brothers that came in the other day, mom's in the 10% tax bracket, right? There's about $400,000 of tax deferred money, right, that they're going to pay taxes on. Both of them are in the 22% tax bracket or above, right? So something happens to mom today, they're each going to have $200,000 more that goes on their tax return that's not only going to be taxed at twice what mom would pay, but it's going to be taxed, it's going to make their rate go to the 32% because it's income added on their other income. That's the way taxes work. That's what a progressive system really means. It is now very important that you sit down with mom and dad and go, listen, I'm going to give you the money. We'll do a mock return for you here at the Financial Enhancement Group. It's why we have a CPA on team, and we've got partners that are CPA firms around the state of Indiana. We'll do a mock tax return for you and say, if mom and dad did a Roth conversion of $50,000 or $100,000, whatever it is, here's the amount of tax it would cost you today, Ken, and here's the amount of tax your mom and dad would have to pay. You're going to make a gift to mom and dad of that amount of tax, right, out of your unified credit using your annual exclusion for certain, but you're going to use you're going to make a gift to mom and dad to pay the taxes. They're going to do the Roth conversion. They're going to make you the beneficiary of the Roth conversion because you paid the taxes. If they need to use the money, they can still use the money. Right? It's still their money. They have not made a gift to you. Right? So you're counting on the fact that they're not going to need the money. They're going to live up there, and they're not going to, at the end of the day, change and make your brother the beneficiary because they, that Ken,
That wouldn't be good.
He just didn't turn out like I thought he would, and we all know he doesn't need the money. So why would I leave, as long as you don't have that fear, and especially if you're a standalone child, then you want to help mom and dad do those Roth conversions now. There is a lot of money that will be wasted for people who are not listening to this show right now or not understanding that strategy. But at the end of the day, Ken, we'll test your memories here. There are 2 tax codes in the United States. What are they?
One for the informed, one for the uninformed.
Very good. A+. I'll give a gold star to Ken Dilger on that one. We want you to be informed. We want you to understand. But it does no good to listen to the strategies and not take any action. And that's where we would encourage you to call Angie. She is the line of the first step at the Financial Enhancement Group. If you call in, you're going to talk to Angie. You call 800-928-4001, and what's Angie going to say?
I'm going to say, let's find a time and come on in. I will also send you a checklist that tells you exactly what to bring, and that way we can do a real thorough meeting, and we allow plenty of time to where we're not rushing you. And
it's a 90-minute meeting. I do not believe in wasting time, so if I have one of my advisors in there or myself that happens to be in the room, we're going to sit down and go through what we call next steps. And next steps are very, very simple. Our brand promise is that when you leave the meeting, you're going to get stuff you need to consider today, things you're going to want to consider in the future. And if we partner together in writing, you will get things that you need to understand going forward for your financial future. So I would tell you with that Roth conversion issue, with this change in the Secure Act, it doesn't matter who you are. If you are going to be a beneficiary, if you have an IRA, if you have a 401k, this affects you, your spouse, it affects your kids, it affects everyone. Please do not let a confusing tax code take your money. Give Angie a call at 800-928-4001. Let's find a time to sit down, have a cup of coffee, or you can have water if you prefer. sit down, have this conversation, and see if we can be of help.
Hi, Joni Michaels here. We know you care about your money, but are you tired of worrying about it? The Financial Enhancement Group takes care of people just like you who don't want to worry about their money. As fiduciaries, the team at the Financial Enhancement Group will care for your nest egg just like they would care for their own if they were in your situation. There are many decisions you'll need to make as you face retirement, and the team at the Financial Enhancement Group is here to help you. Call 800-928-4001 or go to yourlifeafterwork.com to set up a time to meet. The confusion and complexity of retirement is almost as daunting as is the excitement of retirement. Don't let your fear and frustration of taxes and investing derail your retirement. Call the Financial Enhancement Group at 800-928-4001. They'll give you a complimentary second opinion on your strategy for retirement. Begin your adventure in your life after work. Call 800-928-4001 or yourlifeafterwork.com. Now back to Consider This program with Joe Clark.
We are breaking down the Secure Act for you, what it means to your RMDs, your stretch IRA, your beneficiaries, and things you might even want to consider with your parents. I'm the host of Consider This program, Joe Clark.
I'm Ken Dilger.
And I'm Angie Kinzer.
And here is our wrap-up that we always have for the show. If you're new to Consider This program, it is a syndicated program across the country. I think we're in 31 states right now. I know we take care of families in 31 states, a little over 1,000 families that we are so honored to be able to take care of. 1,000 people saying that we trust you is very, very meaningful to those of us who work here at the Financial Enhancement Group. We are honored to have that role and that title, and really, really means a lot to us. But different radio stations are different ways, and so you may get to hear the whole show, you may not. So one of the things that we encourage you to do is to download our podcast. It's called Consider This Program. Anywhere you listen to podcasts, you can get it. And if you're not familiar with how to download a podcast, you can call Angie at 800-928-4001. And Angie, you know how to download a podcast, don't you?
Yeah, and if not, we'll figure it out together.
Well, and we have a retired EDS, that'll show you how old we are, engineer. You don't even know what EDS was, do you, Ken?
No idea.
Do you remember the politician with the really big ears named Ross Perot?
Yes.
Okay. Ross Perot pretty much built EDS. So it got gobbled up in the technology world, if you will, but it was a huge engineering firm, multi-billion-dollar deal, and it's where Ross got all of his money. It's why he didn't need a lot of political contributions. Anyhow, you give us a call. If Angie can't help you, Ron will help you figure that out. But I would strongly encourage you to download the podcast if you can. It's a great way to be able to go back and get the show. So we covered a host of things. Somebody would say that we left off college planning. Ken, you have no debt for college, but just one of the things that changed is the ability for you to use $10,000 out of a 529 plan to be able to pay down student debt. That's true if it's a Parent Plus loan in your name or if it's in your kid's name. It's a beautiful, beautiful thing. We're going to walk you through that. That one's long enough. It will be a whole conversation for next week. So we will have that so that you can hear it. Secondly, retirement plans changed. So, a lot of small businesses only don't have a 401k plan because they think they're expensive, they're confusing. Naturally, we have a 401k plan here at the Financial Enhancement Group. We also have about 25 other companies where we manage their 401k plan for them. So we go in and sit down and talk to the employees and the people that are there. But you've never been able to combine money. Ken's in the mortgage industry. He's got a company that has their 401k. So they're paying administrative fees and expenses. We pay administrative fees and expenses. And what's going to happen over the course of 2020 is we'll let people apply. So if you're a small business that's out there, we'll let people apply to join our 401k platform. So instead of having your own 401k, you're able to be a part of ours so that you have fiduciaries that are picking the funds. Remember the law of a fiduciary. I have to treat your money as if it were my money and we were in the same situation, which means I care greatly about fees and expenses. So if you think about this, trust me, my 401k is already in the cheapest place for fees and expenses that I can find. You have the ability to partner with that under the new law. That is pretty cool. We talked about the changes in terms of traditional IRA contributions. You no longer have to be, you no longer are stopped at 70.5 if you still have earned income. We talked about the stretch IRA. Angie, what was the stretch IRA?
That exercise.
That exercise, yeah. No, it's that thing inside of the tax code that allowed your beneficiaries to take money out of your account over an extended period of time. Now they have to take it all out over 10 years in most cases if something were to happen to you. And Ken, we talked about the required minimum distributions, and the good news to that was, I know you were never going to get that one. You can actually take out less.
Less taxes or less money?
Less money, not less taxes. Don't give up on that. Their IRS is still going to get every dollar of it taxed at some point in time, unless you give it to charity. With the QCD, again, one of the things that's still there. But required minimum distributions have been moved to age 72. Now, if you've already started taking them, if you're already over 70.5, anything, if you've already inherited IRAs, the rules didn't change. You know, if somebody died, even if the account is not set up yet, the inherited IRA is not set up, but they died in 2019, you are under the old rules. Congratulations. If you happen to be, was Stern the NBA? Was he the NBA?
Correct, yes.
Yeah. So David Stern, which apparently was very well liked. I'm not an NBA kind of guy. But the commissioner was very well liked from everything that they said on TV. Passed away January 1st of 2020. What rules does he fall under, Ken?
The old one.
No.
The new one, I'm sorry.
2020, right? So, you know, that last few breaths from midnight to January 1st, I hope there was a lot of really
sooner, huh?
I hope there was a lot of really good goodbyes. And this happens. You know, we had 1 year where there was zero estate tax. And a multi-billionaire died down in Texas, and an oil guy, and there was a lot of controversy because it was near the end of the year, and I mean,
was he in bad shape near the end of his life?
It was. We won't go there, but it was. Let's just say that, you know, it's the tax savings was many zeros, and it would have been odd if something would have happened, and, you know, he would have lived into the next year. So he died on the countdown on the right side of the calendar, shall we say. So medical changes, there's now ability for you to get money if you have or adopt children within a year of the event. Doesn't have to be used for medical expenses. You still have to pay the taxes, but Angie, you can pull money out of your IRA or your 401k without a penalty. One of the biggest things that we didn't get to is the kiddie tax. And if you had to file kiddie tax return, and I don't have time to break it down, if you paid it, you know it. The IRS realized that they probably overstated, they outkicked their coverage, as they would say, back in 2017 when they changed the code. So they've kind of gone all the way back to 2018 and said, we're going to give you a do-over. If you paid taxes at the kiddie tax rate, 2018, 2019, 2019, obviously, you don't have to file an amended return. You can even file an amended return for 2018 and get some of that money back. And for some kids, Ken, this is a big deal.
So what's the earned income amount that you have to file taxes?
Well, it's a small amount. It's like
$3,000 or something.
Yeah, I think it's even less than that, actually. But that's not the issue. The kiddie tax is non-earned income. It's investment income or passive income that your son earned off of money that you or your dad or somebody else had given him, and he had this investment income that was coming in, not earned, right? But investment income. In the old rules, which is now we've reverted back to, in the old rules, it would be taxed at yours, the parent's top marginal rate, right? The rules for 2018 and 19 was actually taxed at the trust rates. So there's not a lot of people walking around at the absolute top marginal bracket. Married, filing jointly, you've got to make more than $650,000 a year. Not a lot of those, right? And so now it's back down to the parent's top rate. Really, really good thing for people there. Hey, you're listening to Consider This Program. Give us a call, 800-928-4001.
Hi, Joni Michaels here. Joe's been hosting financial radio programs for over 20 years, and during his 7 years at Purdue, Joe developed the 5 critical elements. You see, there are 5 areas we all go through that can impact and even derail our retirement plans. YourLifeAfterWork.com has been focused on you on your retirement for over 20 years. You may have had a 401k as well as IRAs. Those are all defined contribution plans. Consider This program is about your defined contribution plans becoming defined distributions. You see, we all exit. You'll either take money out of those retirement plans when you decide or when the IRS decides, or your heirs will have to deal with the situation, but we all exit. I encourage you to call 800-928-4001 to meet with one of the talented financial advisors at the Financial Enhancement Group. I've listened to this show for years, and what Joe says just makes sense. Don't you think it's time for you to call 800-928-4001, yourlifeafterwork.com. Now let's get back to the show.
Well, good morning and welcome back to Consider This Program. I'm your host, Joe Clark.
I'm Ken Dilger.
And I'm Angie Kinzer.
And Angie's got something that she wants to bring forth.
I know. We've talked about generations before and about you. Even though you're not truly a baby boomer, you kind of are at heart. So
I am. I'll give you that. I missed it by 2 years, but I probably look more like a baby boomer. And
So what's a baby boomer look like?
old.
Old? Like you?
They like you know.
Looks like you?
Somebody told me I looked younger with my beard that's now gray. I have no idea, but anyhow.
Well, anyway, I found a little quiz that only a true baby boomer can beat this quiz. So I was going to mention a few things on the quiz, but I want Ken to try to answer first. And then
Ken is not a baby boomer.
he is
Ken
not a baby boomer.
Ken is 4 years
but
younger than Joe.
He
so-
may know some of this. And then if you don't know, then Joe gets to answer. So the first question, what song would television networks play to signal the end of the programming day? And if you,
Oh, I remember that. I just,
do you know, Joe?
yeah.
Boy. I was like 5 years old,
Shed
6 years
his
old.
grace on thee and crown the good with brotherhood.
Nope.
From sea to shining sea.
Yes.
America the Beautiful.
Yep, there we go.
Okay, so
Actually, TV shut off, kids.
know.
I know. It's hard to believe that. I tell the young people we hired, believe it or not, McDonald's didn't serve breakfast.
okay, Ken, who or what was Mr. Ed?
Mr. Ed was a horse.
There you
Yay,
go. Not
a
just a
talking
horse, the
horse.
talking horse.
Okay, what was Chatty Cathy?
Chatty Cathy.
Yes.
Oh, I don't know
Your
this one.
choices are a famous dog, a comic book, a talking doll, or a famous parrot.
I'm going to go with famous parrot.
I would have to go with him. I don't know that
Nope,
one.
that one's
I
the
know
talking doll,
expression.
the Chatty Cathy.
I don't remember that.
Yes, okay. And
Yeah, how would guys know that?
I don't know.
That's-
everybody had a Chatty Cathy
You would have
doll.
questioned my manhood if I knew that, wouldn't you? Again, I can just see that look.
Okay, this is pretty manly. Where could budding biologists order sea monkeys? Either the local zoo, the pet store, ads in the comic book, or the drugstore. Sea monkeys.
I'm going to go the pet store.
They were
Nope.
at the drugstore. They were all over the place.
Yep, the actual answer to that is the comic book. They used to take ads for
They-
sea monkeys in
they
the
would
back
advertise them that
of,
you-
Sea monkeys? What is
Yeah.
a sea monkey?
It was.
that you add water to them. They were like, they came in a little packet and they were kind of dried things, and
And
then
they
when you added
like a
water, they'd
sponge.
come alive. It was some kind of bacteria, and it would
was
swim
really-
around, and they called them sea monkeys
It
because
was
it was
really
shaped kinda
weird, wild, and wacky when you think about it. Do you remember Stardust?
Oh, yeah.
It was about the same period of time when here's a great idea. Let's put stuff in your mouth that pops that you
Those
know
Pop
you,
Rocks.
that you don't even know what it is and what it was. We're out of time, Angie, but we will finish this because next time she's going to get me with the millennial questions
Yes.
that I probably won't have any clue at. Hey, thanks for joining the show. Don't forget to give Angie a call, 800-928-4001. Have a great week.
You've been listening to Consider This Program with Joe Clark. As a certified financial planner, former professor at Purdue University, and with 31 years of experience helping families just like you eliminate the fear and confusion of retirement, Joe's team has the answers to your questions. Go to yourlifeafterwork.com or call 800-928-4001 and find a time to meet with the Financial Enhancement Group. There's nothing that will separate you from your retirement as fast as the IRS. There are many questions that can be answered at the Financial Enhancement Group. Questions like when to take Social Security, how will my 401k be taxed? These questions are just the tip of the iceberg, and you need to be asking these questions now before it's too late. The Financial Enhancement Group has offices in Anderson, Fishers, and Lafayette, Indiana, but they also take care of families in 30 other states. You care about your retirement, you don't want to worry about your money? Then the Financial Enhancement Group is right for you. As fiduciaries, they are required by law to treat your money as if it were their own and they were in the same situation. Call 800